All right, the date is July 1st, 2026. For years, the broader market treated quantum computing like a giant science fair project, a theoretical technology that was permanently a decade away from actually moving the needle. But the landscape has violently shifted. Today, we're breaking down the absolute ultimate quantum computing debate. We are looking at the bull versus bear case for IonQ, and we're separating the undeniable quality of the underlying business from the completely gravity-defying reality of its stock valuation. 755%. That single number just totally shattered the market's assumptions. In the first quarter of 2026, IonQ reported year-over-year revenue growth of 755%. I mean, while traditional computing and AI hardware companies were out there reporting normalizing growth, IonQ delivered an absolute shock to the system. It basically proved that commercial quantum deployment isn't just some futuristic concept anymore. It is happening right now on a massive scale. They didn't just inch their way forward. We're talking about a massive vault from $7.6 million in Q1 2025 straight up to $64.7 million in one single quarter. And this wasn't driven by some isolated government research grant either. This was driven by genuine, hardcore enterprise demand, international expansion spanning 30 different countries, and aggressive cross-selling of multiple product lines across their cloud platforms. Wall Street has basically been forced to completely reevaluate what this company is actually worth. But hey, past performance is really just a rear-view mirror, right? What really matters is what's coming down the pipe. IonQ's remaining performance obligations, which is essentially their contracted future backlog, just surged 554% to $470 million. That proves that the Q1 revenue wasn't just a lucky one-off spike. This is contracted, locked-in future demand from serious commercial and government players who are securing capacity for the years ahead. Section 1. The tech, suspended coins, and lasers. So to understand why all this money is suddenly flowing in, we have to grasp the hardware. We need to establish exactly what IonQ does and why their approach is fundamentally different from the rest of the industry. IonQ relies on what's called trapped ion technology. Think of their qubits like individual coins, suspended perfectly still in a vacuum using electromagnetic fields. Once they are suspended, these ultra-precision lasers manipulate the coins to run highly complex algorithms. And because every single atom of a given element is naturally identical, these qubits are perfect right out of the box, which gives them incredibly long coherence times. Think about the heavyweights for a second. Companies like IBM and Google. They use superconducting qubits. Those run operations incredibly fast, for sure, but they face immense engineering challenges with noise and scaling. IonQ's trapped ions, on the other hand, are naturally identical. They offer massive fidelity and all-to-all connectivity, meaning any qubit can literally talk directly to any other qubit. They run slower, yeah, but they make way fewer errors, which is arguably the single most critical factor in achieving actual useful quantum computation. Section 2. Building the full stack. IonQ isn't just building standalone computers anymore. They're basically using their crazy $18 billion valuation as currency to pivot from a pure hardware builder into a fully vertically integrated, full-stack quantum platform. Through 2024 and 2025, they went on a relentless acquisition spree. They bought networking specialist Qubitekk. Then they acquired Oxford Ionics for $1.1 billion to integrate their super complex laser controls into scalable 2D microchips. And then, in 2026, they agreed to buy Skywater, a U.S. semiconductor foundry, for $1.8 billion. They are literally buying up their own manufacturing supply chain to guarantee they control every single step of the process. The result? You've got a company that now sells into multiple massive markets simultaneously. They aren't just selling compute time on AWS and Azure anymore. We're talking about deploying quantum networking nodes, atomic sensors, cybersecurity frameworks, and space infrastructure. If you want bull versus bears stock analysis without hype for the companies shaping our future, subscribe to Future Ready. Section 3. Financials, reality versus illusion. Okay, we need to untangle the quantum hype from the gritty reality of the balance sheet here. Because while the tech is absolutely extraordinary, the financial mechanics driving the stock require some serious scrutiny. The tension here is immense. On the positive side, IonQ has a bulletproof $3.1 billion in cash and investments that gives them unmatched financial endurance to weather the whole quantum development cycle. But directly against that, they posted a pretty alarming $271.5 million operating loss in a single quarter. They are burning through roughly $150 million of cash every 3 months just to fund this aggressive expansion. Now, you might have caught some headlines recently claiming IonQ posted an $800 million net profit last quarter. We need to strictly clarify this right now because it's a massive trap for retail investors. That figure is an accounting illusion. It was driven entirely by a non-cash gain on the changing value of warrant liabilities. It is absolutely not actual money the business made from selling products. Strip away the clever accounting, and the reality is steep, continuous operating losses. And to fund all of this aggressive cash burn, IonQ diluted its outstanding shares by a whopping 59% over 2025 using at-the-market programs and massive stock offerings. This is the quiet tax on long-term shareholders. The company's overall market cap can grow while your actual personal slice of the business shrinks. You absolutely have to account for this dilution when you're modeling out future returns. Section 4. The bull case. So, despite that heavy cash burn, institutional appetite for this stock remains absolutely ravenous. Let's look at the strongest arguments for accumulating IonQ, zooming in on their unique commercial validation and their scaling roadmap. Instead of trying to cram millions of physical qubits into one impossibly large, freezing chandelier setup like some of their competitors, IonQ's strategy is brilliantly modular. Step 1. Build perfectly functioning, small, chip-based systems. Step 2. Rely on their networking acquisitions to seamlessly connect those distinct systems together using photons. And Step 3. Achieve massive fault-tolerant scale through this entirely networked architecture. It is literally the data center model, just applied to quantum physics. Commercially, they're already winning the race. 60% of their revenue is commercial now, which just proves the enterprise demand is real. Plus, they secured eligibility in the massive $151 billion MDA Shield IDIQ contract framework, and they are fully embedded in DARPA's HARQ program. By owning their own U.S. foundry and a completely domestic supply chain, they are perfectly positioned for defense applications where national security is paramount. If you want bull versus bear stock analysis without hype for the companies shaping our future, subscribe to Future Ready. Section 5. The bear case. But look, every compelling growth story casts a shadow, right? We have to pivot to the skeptic's view and ask a really hard question. Is an $18 billion valuation completely detached from the underlying realities of a company that's generating around $260 million in projected annual revenue? The crucial point is the competitive landscape. When you neutrally compare IonQ to its primary private rival, Quantinuum, a major split emerges. IonQ is clearly winning the business race right now. They've got a massive revenue lead and a brilliant full-stack sales engine. But Quantinuum is arguably winning the core technical race. They've actually demonstrated 48 error-corrected logical qubits on their latest system, which maps directly to the entire industry's ultimate goal of fault-tolerant computation. The real bear case isn't that the technology just completely fails tomorrow. It's that with a severely negative 176 price-to-earnings ratio, absolute perfection is already priced into the stock. The market is basically valuing IonQ as if it has already conquered the fault-tolerant era. Any slight delay in their technical roadmap, any stumble at all integrating that $1.8 billion Skywater acquisition could trigger a severe and violent repricing of the stock. Section 6. The verdict. We've got to separate the undeniable momentum of the underlying business from the extreme volatility of the stock. This is our final, evidence-based outlook on exactly where we stand today. For swing traders, the setup is electric. With a 13.6% short interest and a massive beta of 3.18, the stock moves more than 3 times as aggressively as the broader market. You're playing extreme volatility driven by contract announcements and earnings beats. For long-term investors, the focus has to be entirely different. You're watching the gritty execution, you're tracking the integration of Oxford Ionics into actual chip manufacturing, managing the cash burn, and hitting concrete, logical qubit milestones. If you want bull versus bear stock analysis without hype for the companies shaping our future, subscribe to Future Ready. Based on the data right now, the most reasonable action today is to accumulate on sharp pullbacks. The $18 billion valuation leaves zero margin for error right now, which makes buying at the very top of a momentum rally exceptionally risky. Waiting for market-driven corrections provides a far better risk-to-reward ratio for a company that undeniably leads the commercial quantum space. Keep in mind, this reflects current information and is strictly not financial advice. They've got the cash. They've got the contracted backlog. They own the U.S. supply chain. But the physics of error correction still remain the ultimate judge. Will this hyper-aggressive, multi-billion-dollar acquisition spree cement IonQ as the foundational platform of our next computing era? Or will it simply act as a vehicle that dilutes early investors into the ground long before the fault-tolerant revolution finally arrives?